Welcome everyone to another month, another edition of the series that we are putting on. Glad to have everyone. In this series today, we're going to be talking about money, and the financial controls involved. Different aspects of financial literacy, understanding different aspects of the business that are worth monitoring and keeping a good pulse on, KPIs, and a variety of other key performance indicators, and a variety of other elements to keep a good pulse on inside of the business. As usual, we've got the awesome, amazing, incredible Arjan Robbins, founder of How to Manage, with over 800 law firms that they manage on a monthly basis, from the CEO side of things, COO side of things, and a variety of other capacities. So, Arjan, man, I'm excited for another go around.
Thank you. 620 as of today, not 800.
Almost there.
And we got 50 more coming online tomorrow.
Love it. So tell everyone where you're at right now.
So I'm in San Antonio. We have a live quarterly meeting that we run every quarter. It's kind of a combination of one of the most substantive, in-depth, concrete, practical, actionable workshops you probably ever attended in your life on the subject of the business of running a law firm. And we do these every single quarter. Part family reunion. We'll have about 700 people in this room by the time they're done setting up. The whole thing kicks off tomorrow afternoon, Friday. Every quarterly meeting is a completely different topic. We go an inch wide and we drill a mile deep onto it. Our members come back quarter after quarter after quarter after quarter after quarter. So that should tell you something. You've actually been to one of them.
Yep, they're amazing. Really well put together events that do exactly that. Go a mile deep.
Yeah, it's kind of frustrating for us because most lawyers, myself included, we've been to so many really boring, crappy events that don't deliver real value. You know, just basically a pitch fest. I mean, this is members only. This is like a fulfillment event. There's like, you can't get into this room unless you're already a member or a friend of a member. So we don't waste time like trying to set ourselves up and introduce ourselves and pitch something to you. So that's why they're so substantive. So anyway, they're setting up here because the Wi-Fi in my suite crapped out 15 minutes ago, and all the other rooms that are in the hotel are being used by my team for different things. So here I am.
We make it work. I love it.
Make it work.
So let's dive into it. Financial controls. I think that one of the elements that is overlooked and sort of been a golden thread or a theme of a lot of the stuff that we've covered thus far is this stuff just isn't taught in law school. A lot of these elements, have nothing to do with the bar. It's more about running the business of a law firm. So how would you describe the importance of having really dialed in metrics and financial controls in the business that can set a law firm up for significantly more success and then obviously money?
So I think we talked about this a long time ago, or maybe we talked about it when we first were kicking around the idea of doing this whole series. I believe that as attorneys, your audience, I believe we as attorneys, we have an ethical and professional responsibility to run a profitable law firm. I think it is unprofessional, unethical, and downright dishonest to run an unprofitable law firm. I think it is tantamount to fraud in the inducement when you have a client who hires you and you have no financial controls of your business and you're, 2 steps away from being broke. And I appreciate that that's an unpopular position, but I've been expressing this position all over the country for 20 years, and a lot of people have criticized me for it, but no one can really fault the logic behind it, right? So think about it, Trey. When you hire a lawyer, you've hired lawyers for lots of things, right?
Yep.
If the lawyer said to you, listen, before you sign this engagement agreement, I need to disclose something to you. And you're like, okay, what do you need to disclose to me? And the lawyer says, you need to know that I'm broke. I have no cash reserves. I'm tapped out on my credit. My line of credit is overextended. I don't exactly know how I'm going to be making payroll 30 days from now. I don't know how I'm going to make rent in 2 weeks. I'm not sure how I'm going to still be in business, financially speaking, 6 months from now, when your case is likely to, get to a hearing or get to trial or whatever. if you're okay hiring me under these terms, let's go, I'll be your attorney. Would you hire that lawyer? Yes or no?
Not a chance.
No chance, no way, right?
Nope.
So what that means is that that piece of information is material. Right now, if the lawyer said, listen, before you hire me, I need to disclose something to you. Okay, what do you need to disclose? And the answer is, my socks don't match. You need to know my socks don't match. Would that make a difference? No, you don't care because it's not material, right? So there's certain things that are material and certain things that are not material. And when you mislead a person, or you allow a person to enter into an engagement or into an agreement when you know they misunderstand a material fact, that's called fraud. It's fraud in the inducement. You understand?
Yep.
Like this is a cause of action that lawyers sue people for doing to their clients. And yet law firms are doing this all the time because they have no financial controls, they have no cash reserves, they're not being run profitably, they don't know what's going on with the finances of their business, but they don't disclose it to the client. That's called fraud, the inducement. Anyway, your question was, why does this matter? It matters because you have an ethical obligation to run your law firm profitably. You have an ethical obligation to make sure that your firm is properly staffed. That takes profit. Properly resourced. That takes financial resources. You need to make sure that your client is getting what they paid for, which is the best version of you, not a stressed out, broke version of you. This all happens because of financial controls.
So financial controls, most business, not just most attorneys, most business owners operate the business based on the idea or the concept, oh, there's money in the bank, I'll go do the thing or buy the thing or operate whatever money in the bank account.
How my 7-year-old operates his savings account. He's got this little backpack. It's a little mini backpack. It's the cutest thing. It's a Mickey Mouse backpack that he got at Disney World where he stashes his cash, right? So he does chores around the house and he bargains and he negotiates and he's got like, a few $100s that he saved up in there. He comes to our kids' entrepreneur club and he sells things. And he basically operates on the basis of how much cash do I have in the bank? He's 7 years old. Come on, we're adults. We're entrepreneurs. We're supposed to be taking on serious problems for serious people. And that requires us to take the financial controls of our business seriously, because the financial controls of our business affect every other part of our business. We might want to pretend like, oh, I'm a great lawyer. The finances shouldn't matter, but they do.
Absolutely, they do. So if I'm an attorney and I operate based off of what is in the bank account, and maybe I've got a bookkeeper who, does the books for me, but I don't really look at them, which I think what I've just described is how most law practices are run to a certain degree.
That's also where a lot of legal malpractice actions start, right? The germination, the seed of a malpractice action germinates in bad financial controls, because bad financial controls take root and they sprout and they cause people to make bad, expedient decisions that they know they shouldn't be making. They take the wrong client because they're broke, because suddenly they've got a cash crunch. They turn the marketing on, they turn the marketing off because they don't have money to fund a consistent marketing campaign that brings in consistent, predictable business. They don't hire the best people they can get because they're afraid of spending the money because they don't have the financial controls, and on and on. And they don't invest in training. I mean, it goes on and on and on. So many of the legal malpractice claims that get filed start off as bad financial controls in a business. The flip side of it, and let's put this on a positive note, and let's stay positive here now, okay? The flip side of it is when you put good financial controls in place, it gives you a huge competitive advantage in your marketing. It gives you a huge competitive advantage in your sales. It gives you a huge competitive advantage in your recruiting. It gives you a huge competitive advantage in every aspect of your business. And you could be not as good of a lawyer as the next one, but if you've got good financial controls in place, your law firm can make more profit, and you can end up delivering better services to your clients than the other lawyer who's a better lawyer, but has bad financial controls. So I want to focus on the positive and not just like wag my finger and complain about everything.
Yeah. So where, if I am that attorney and I operate based off of what's been in the bank account and I have a bookkeeper, what are the financial controls that I should be more proactive about installing, and more importantly, monitoring on an ongoing basis inside of the practice?
Okay. So, you are a phenomenal, amazing, competitive bicycle rider, right?
Yep.
And the glory is when you're in the big race and everyone's cheering you on and you finish and you cross the finish line in first place and you get the award. That's the glory, right?
Yep.
All right. Now tell everyone about all of the shit that you have to do, the mornings you wake up early, the road work you have to do, that no one's looking and no one's cheering and no one's saying anything, and you're just out there grinding it out and grinding it out and grinding it out and doing some really unsexy stuff so that you can get the glory later on. Tell me about that for a minute while I find an image to share with you.
Yeah, it's it's one of those things. And I think the closest thing to entrepreneurship, or even that world, is like an overnight success 10 years in the making. No one sees all of the grind through that period of time. When I was racing at the professional level, it was one of these things where, you get up, you'll ride 80 to 100 miles a day, every day, for days or weeks on end, and prep for a particular big event. And oftentimes it's in the cold and it's in the rain. It's all of these elements that you don't really want to end up doing. And then dealing with all of the, the people who want to cut you off or run you off the road, and all of the other sort of elements that you have to face. I eventually did get hit by a car that took me sort of out of it. It's another story for another day. But the amount of work or time or effort to put in, or even just the opportunity to be in the upper echelon, was inordinately unproportioned to what most people would be comfortable doing, I would say.
Can you see this?
Yep.
Hungry to win, hungry to do what winning requires. Winning requires the owner of a law firm to put on their big boy pants or their big girl pants or their big person pants and take responsibility for the financial controls of their business. Now, this doesn't mean you need to do the bookkeeping yourself. In fact, you should not do the bookkeeping yourself. This does not mean you should be a chief financial officer. You should not be a chief financial officer. But you need to educate yourself. You need to do what is required to have a profitable business so that you can enjoy all the benefits of having a profitable business. Dre, I think your audience, from what we've seen over the past several months, is more sophisticated, more mature, more rational, maybe you want to say smarter than the average audience of lawyers that I'm used to speaking to. And that's a testament to Daniel's head. You attract great people. So with that in mind, would it be okay if we didn't spend a bunch of time trying to show everyone how great life can be and trust everyone, that everyone here is smart enough and rational enough and mature enough to understand that when your law firm is more profitable, when your profits are more predictable, when your cash flow is more predictable, when you know what's going on in your business, everything is better? Or I mean, I just don't want to spend 15 minutes explaining all the things.
No, I think that with all the amount of elements that we've covered in previous episodes, I think that hopefully that would be very clear and abundantly obvious.
Yeah. Maybe anyone who doesn't get it has some bigger problems.
We'll go with that.
All right. So let's get right to it. Some of the really unsexy, not glamorous. This is, the day after tomorrow, there's going to be a big stage and it's going to be very glamorous. And I'm going to be on stage, and everyone's going to be like, "Oh, look at that! It's so glamorous," right? But this is the reality of what it takes to make it happen, right? It's not glamorous. So let's talk about some of the unglamorous stuff to put proper financial controls in place so you can get the glory later. Okay?
Yep.
All right. Really, really, really foundational stuff. Chart of accounts. It starts with the chart of accounts. If your chart of accounts is crap, all of your financial controls are going to be crap. If you don't understand your chart of accounts, you're not going to ever understand the rest of the financials in your business. It all starts with the chart of accounts. It's the unsung hero of really profitable businesses. All right. So a chart of accounts is something that's everyone understands it if you think of it this way, right? So it's the technical explanation of a chart of accounts is it's the categories of income and the categories of expenses that make sense to you to keep track of. It's the categories of income and the categories of expenses that make sense to you to keep track of. All right.
Yep.
So everyone intuitively understands what a chart of accounts is because everyone has tried to put together a household budget, right? So you've got his income, her income, their income, rental income, investment income. These will be 5 different lines in the chart of accounts, all called income. Make sense?
Yep.
All right. And then everyone knows what expenses are. You've got a mortgage expense, you've got insurance expense, you've got education expense, you've got grocery expense, you've got housekeeping expense, car expense, et cetera, et cetera, et cetera. These are categories of expenses. Yes?
Yep.
Okay. Now, let's say that there's 2 different accountants, 2 different bookkeepers or 2 different accountants for the same client. All right. And one accountant says that the client has a car expense of $500 a month. And the other accountant says the client has a car expense of $1,000 a month. And both accountants are right. It's the same car, the same money, same client, 2 different accountants, 2 different bookkeepers. One says the expense is $500 a month. The other says the expense is $1,000 a month, and they're both right. Let me explain how this can be. I've given this example to thousands and thousands and thousands of lawyers all over the country, all different practice areas from all walks of life. It's usually fun when it's interactive and we have this real big, lively, interactive discussion about, well, how could that be? And everyone comes up with their ideas. Let me explain it, okay? The first accountant is counting just the car payment and then tracks the insurance and the fuel and the maintenance under separate categories. The second accountant just takes all of the expenses related to the car and lumps them all together as car expense. You following me, Dre?
Yep.
Okay. Which is right?
I think both.
That's right. Both are right. Either is right.
Yeah, it depends on how you want to, break down the P&L.
It all depends on how you want to, on how you, the owner of the law firm, you, the owner of your business, what makes the most sense to you? That's the right way to do it, right? But now you're starting to see what happens, Dre. Most lawyers are not involved in the decisions that get made in how the chart of accounts will get constructed.
Yeah.
And so it doesn't get constructed in a way that makes sense to the owner of the firm. It gets made in a way that makes sense to the bookkeeper or the accountant. Yeah?
Yep.
All right. It's almost like saying, you're a great chef, so you should decide what I'm going to have for dinner. No, the great chef is supposed to say to the customer, what would you like for dinner? What are you in the mood for? Do you have any allergies? Do you have any food issues, right? The chef is not supposed to dictate the menu to the customer. The customer is supposed to have input on the menu to the chefs. The accountant is not the accountant, the bookkeeper, the world's greatest accountant. You know you got a great accountant. You know you got a great bookkeeper when they have a strong enough ego and enough maturity and enough experience to say to you, we need to work together to decide what your chart of accounts will be for you. What most bookkeepers wind up doing to their clients, unfortunately, is they impose their decisions onto the client. And then what's worse, they make a million little items in the chart of accounts that don't matter, right? So instead of just putting one big category called office supplies, they end up with pens, paper, pencils, erasers, staples, paper clips. Like, who the fuck cares, right? Until you've got office supplies like $10,000 a month, who cares whether it's pens, paper, pencils, or paper clips? You get what I'm saying? Just call it
100%.
office supplies and let's get on to things that matter.
Yep.
Anyway, the chart of accounts, I'm spending a lot of time on it because if you don't get a chart of accounts that makes sense to you as the owner, the rest of it won't make sense, because what you do with the chart of accounts is you now repeat the chart of accounts 12 times. And that's where your budget comes from. So if your chart of accounts doesn't make sense to you, then your budget won't make sense to you either. Make sense?
Yep. So you're saying 12 primary accounts that people should monitor in the business.
No, that's not what I'm saying. What I'm saying is you got your chart of accounts, income, categories of income, categories of expense.
Yep.
Income, expense. A, B, C. D, E, F. That's your chart of accounts.
Got it.
Got it?
Yep.
Now you take that chart of accounts.
Oh, you're saying annualize it for
Month
each
2,
month.
month 3.
Got it.
And that's a budget. That's how you convert a chart of accounts into a budget. But if your chart of accounts doesn't make any sense to you, then your budget's not going to make any sense to you.
Yep.
And if your budget doesn't make any sense to you, then your budget variance report won't make any sense to you. And your budget variance report is, in my opinion, the most important financial management tool there is. If I had only one tool that I could use, if I had only one thing I could look at for running my business, it would be my budget variance report. Because the budget variance report takes your budget, see that? And you got categories. So it's budget, reality, dollar percentage, and why. That's a budget variance report. What were you budgeting? A budget is also known as your best estimated guess. And anyone who tries to make a budget something more than a best educated guess is blowing smoke up your butt. That's what I run a $30 million business. We manage over 600 law firms. And my budget, today is January. My budget for the rest of the year is already planned out. But I know it's just our best educated guess about what's going to happen, right?
Yep.
So every month you look at your budget, your best educated guess, you compare it to reality, what actually happened, what's the dollar or percentage difference, and why. Now your bookkeeper or your accountant can give you the information for all of this except the last one, which is why. For why, you as the lawyer need to put on your thinking cap and figure out why was reality different than what you expected, projected, or planned. You with me so far?
Yep.
So the example that I love to give is, let's say that you budgeted that you were going to spend $100 a month on gasoline for marketing related activities. With me?
Fair. Yep.
All right. And reality comes along and you spent $200 on gasoline for law firm marketing related activities, which is $100 over budget, which is 100% over budget. What do you think most bookkeepers are going to tell you that you need to do?
You need to not do your marketing expenses the next month in order to even out the budget.
Right. Most bookkeepers are going to come in and they're going to say, you spent too much last month. You need to spend less money now, because they're not connecting the expense with the intention or the expectation or the plan behind the expense.
Yep.
With me?
Yep.
This is why you can't let a bookkeeper or an accountant make a budget for you. You have to make a plan and then say to the bookkeeper or the accountant, help me translate my plan into a budget. Help me translate my words, my concepts, my ideas, my plans, my expectations, my hypotheses, the premises upon which I'm basing my decisions. Help me translate all of that into numbers that we can put into a budget. That is what the role of the accountant or the bookkeeper. Your job as the owner is to make the plan. You with me so far?
Yep.
So you're absolutely right. If you plan to spend $100 a month on gasoline, and then month comes along and you spend $200 a month on gasoline, most bookkeepers, most accountants, without even stopping to think about it, are going to come running in and say, you got to spend less money on gasoline. Now, the correct thing to do, what a chief financial officer does, what a CFO does, we CFO hundreds of law firms. And what a CFO does is helps you figure out why. Why were we $100 over the budget? So you want to take a couple guesses? There's no really wrong answer here.
You could have had additional meetings, extra marketing or opportunities that you had to drive to, various other networking events. If gasoline is the transportation elements to get there, it could be one of a variety of elements.
Right. So let's just go through these methodically just a little bit. Okay. One, this is just like discovery. See, lawyers are better at budget variance analysis than accountants, because lawyers, we are trained in the art of discovery, right? So all you're doing is basically deposing, cross-examining, if you will, the budget variance report to figure out what's real and what's bullshit, right? So let's go through this methodically, just like you would go through and depose a hostile witness. We thought we were going to spend $100 a month on gasoline. We spent $200 a month on gasoline. Did the price of gasoline double? No, it did not. Okay, that's not the reason. Did we change vehicles? We thought we were going to drive a Prius and now we're driving an Escalade. No, that didn't happen. Okay. Or maybe those happened a little bit and that only explains part of the difference. All right. But you keep working on it, chipping away till you figure it out. And you can figure this out. If you went to law school, if you're practicing law, you can figure this out. It's just a matter of thinking this through systematically. Okay. So did the price of gasoline go up? No. Did we change cars? No. Did we drive more? Yes, we drove more. Did we drive twice as much as we thought we were going to drive? Yes, we drove twice as much as we thought we were going to drive. Why did we drive twice as much as we thought we were going to drive? Well, we drove twice as much because we had twice as many networking opportunities to go to, and that produced twice as much new business, and now our revenues are going to double. Now, all of a sudden, what we should do next month is not cut the marketing gasoline spend down to 100. We should think about maybe we should raise it from 200 to 400. You following what I'm saying here, Dre?
100%. Yep.
And like true, here's two true stories that we found when we've done this. Now, first of all, the marketing thing, completely true. The price of gasoline going up is always part of it. Changing vehicles, part of it. But here's three other things that we find. True story. One is we found that a law firm, we find this a lot, where law firms are literally sabotaging and crushing their marketing opportunities because their accountant told them, we said you're spending too much on these things, irrespective of the value that's being produced on the other side.
Yep.
All right. But here's two really interesting stories. One we went through it. We couldn't figure it out. I mean, there was no way to explain the variance. And then we noticed that that the money was being spent on a gas card. What's going on here? So we begin investigating the gas card, and we realize that the gas card is being charged. It's always being charged twice in a row. You follow? Charge, wait a minute, charge. We investigate, and we find out that the person who has the gas card, the marketing biz dev kind of person for the law firm, would fill up her tank, and then she'd fill up her boyfriend's tank. And we found fraud because we were looking at the budget variance report, because we had an expectation of how much gas she was going to use every month. She was using twice as much gas as we expected. We went through every possible way to try to figure it out and explain it. And then as a last resort, we just looked at the gas card and we saw the charges were like weird. And then we found out what was happening. Pretty interesting, right?
Yep.
All right. And this is like, $100 a month. I mean, who cares? It's not that big a deal. But, imagine this in a much bigger scale. Second situation is actually more scary. We couldn't figure it out. I mean, we were racking our brains. I mean, literally as a last resort, we said, we can't figure this out. Take your car to the mechanic and find out what's going on. Your car just somehow using gas. We can't figure it out. Well, the mechanic finds out that the car, it was an old Subaru, and there was a thing on the top of the gas tank, which is right under the rear seat, and it was loose, and gas was like sloshing out under the back seat and leaking out the bottom of the car. And this person was like driving around in a bomb that the mechanic found. And, budget variance analysis saved a life and the environment.
Oh my goodness.
It's a true story.
Hey, I believe it.
This kind of stuff happens, right? I mean, these are silly little stories, a tank of gasoline, who cares? Yeah, if you're running a $50,000 law firm, a $200,000 law firm, but if you're going to run a multi-million dollar law firm, you better pay attention to these things because they matter. All right.
So, log the chart of accounts.
Chart of accounts.
Yep.
Turn the chart of accounts into a plan, right? So when most accountants read a chart of accounts, when most accountants read a chart of accounts or a budget, they look at the numbers first. And then after they look at the numbers, they look at the notes afterwards. You know what I'm saying?
Yep.
I don't do that because I'm not an accountant and I don't have an MBA and I'm not good at math. I look at the notes first. And if the notes make sense to me, if the explanations in the notes, if I can understand the explanation in the notes, then I look at the numbers to see if the numbers back up the explanation. Most accountants look at the numbers first, and then they see if the explanation backs up the numbers. I look at the notes first, and then I see, do the numbers back up the notes in the explanation? Make sense?
Yep.
So you take your chart of accounts, which is really just how you're dividing up and keeping track of categories of revenue and categories of expense. Then you look at the notes, which is the reason, the rationale, the explanation for why those numbers, what you think those numbers, where those numbers come from and what those numbers mean. Then you translate that into a budget, which is a 12-month projection of revenue, category by category, and a 12-month projection of expenses, category by category, backed up by explanations, i.e. plans. And then you do a budget variance report to see where you were, where you're on track, where you're off track, the percentage that you're on track or off track, the reason why you're on track or off track. That's up to you to figure out. And then, of course, you got to make a plan for it. And what are we going to do about it? Right. And if you're making these analyses every month, then you're making small little pivots all year long instead of winding up at the end of the year way off track. Like this year, we actually we were only $400,000 off of our goal. So think about this. December of the year before, we sat down and we made a budget and a financial plan and a profit projection and all of that. You with me?
Yep.
12 months later, we were only off by $400,000 on our gross revenue. And we were off by less than $400,000 on our net profit. That's pretty extraordinary. That's because we're constantly reviewing it and pivoting and adjusting and zigging and zagging and pivoting, and you zigzag your way to your goal.
So
I should mention 400,000 out of 30 million.
yeah, I was going to preface that with like, well, if you're running a $400,000 practice, it's not really a big deal. You were off by 100%.
Yeah, out of 30. Yeah, so we projected 30 million. We did 29,600,000. You know,
pretty darn good.
Pretty close.
If is this something that you say go throw it in an Excel sheet, do it on a piece of paper? Like, what is the best way to actually set someone else and say, this is it? Like, my bookkeeper's done all of the things that you said. What is the best next step for them to start like actually installing this into the practice?
Right. So we could do a whole other thing on how to do the work yourself, but that's not my recommendation. My recommendation is that you hire a bookkeeper who doesn't suck, who can give you these reports, because then you can do the fun part, which is the analysis. Right? Your bookkeeper every month should give you a 12-month forward-looking budget. Every month, your bookkeeper should revise and update your budget for the next 12 months going forward. Your bookkeeper every month should give you a profit and loss statement, which tells you how much revenue came in, category by category by category, where the expenses were, category by category by category. Did you make a profit or was there a loss? Every month, your bookkeeper should give you a balance sheet. What assets did you start the month with? What assets did you end the month with? How much liability did you start the month with? How much liability did you end the month with? And how much equity did you gain or how much equity did you lose as a result of all of this activity? So profit and loss is cash flow. Balance sheet is equity. Two very different concepts, not to be confused. But your bookkeeper should give you these reports, and your bookkeeper should walk you through these reports and help you understand what these reports are telling you. If your bookkeeper is not giving you these reports, that's a problem. You need to find a better bookkeeper. Or maybe say to your bookkeeper, if I paid you more, would you actually do the job that I need done? And then your bookkeeper should walk you through this stuff. So budget variance report, cash flow projection. So you take that 12-month budget that I was talking about, right? And now you break it down into the next 6 to 8 weeks, week by week by week by week. Week 1, beginning cash balance, $100,000. How much cash do we expect to bring in during this week? $10,000. At the end of the week, we expect to start 100,000 plus 10,000, 110,000. And what expenses do we expect to incur this first week? $90,000. How much cash do we expect to end the week with? $20,000, which means next week we expect to start the week with $20,000 and we expect to bring in $50,000, which means 20 plus 50 is 70. And how much expense do we expect to incur? We expect to incur $71,000. Hold on a second. Wait a second. That means we're going to be in a loss, which means we need to tap into the line of credit, or we need to call some of the vendors and say, hey, can I pay you next week? Or we need to call some of the people who owe us money and get them to pay us earlier. But the point is, we know this weeks in advance. You know, if you tell me that I've got a cash crunch today, there's nothing I can do. If you tell me I got a cash crunch taking, that's going to happen a week from now, I can kind of buckle up and brace myself. But you tell me that I got a cash crunch 6 weeks from now, I have lots of things I could do to prevent that from happening. You know what I mean?
Yep.
But without a cash flow projection, what ends up happening is owners of law firms, it's like they're driving 80 miles an hour down a road, and all of a sudden they go flying off a cliff because no one told them there's a sharp left turn coming up.
Yeah, it's like driving in the rearview mirror. You can't see what's in front of you.
Yeah.
I think using the
budget. So 12-month forward-looking budget, a monthly budget variance report, a weekly cash flow projection. You want to have a cash balance. You want to know how much cash do you have in your operating account, how much cash do you have in your trust account, and how much cash do you have in some of your reserve accounts that hope you're putting money aside in reserve accounts for future expenses. And you need to know budget variance report, cash flow projection, cash on hand. Oh, and work in progress. Work you've got going on now that's in the pipeline that's not yet ready to be billed. When is that work going to come out the end of the pipeline and we can turn it into revenue coming in? You put these 5 reports in place and you will transform the quality of your life. In the beginning, it might be for the worse, which is why most people don't do it, because it's scary and it's intimidating, and maybe you don't like what you're seeing. But, do you want to be, ignorance is not bliss. Ignorance is just ignorant. Once you see what's the truth, then you can do something about it.
So there's a lot there that you just sort of unpacked.
Yeah, a lot. I'm sorry, going fast.
No, you're good. Is there I definitely would not recommend them doing this themselves. So other than obviously hiring how to manage to go do these things for them, is there particular guidance that you would say that you would want them to go to a bookkeeper and say, how I want you to step up? Like, are you looking to the bookkeeper to make these changes with the reports? Are you hoping that the law firm owner would say and take the information you just delivered and go to the bookkeeper? Or like, what would be some of the next tactical steps after sharing what you just shared that someone could go take and implement if they already have that bookkeeper in progress? Like, you say, hey, these are the 4 things I want you to go do, and then fingers crossed and hope for the best.
So my big message, if you're watching this, if you're listening to this and you learn nothing else from this entire podcast or this entire episode, learn this. I want you to be a proactive, engaged, informed consumer of the bookkeeping and accounting services that you are paying for. Do not abdicate this to your bookkeeper or your accountant. There is no credential. There is no, well, my accountant is a CPA from Harvard University who's the best CPA in the world. You'll know someone's a great CPA and you'll know someone's a great bookkeeper when they are very solicitous of your input into how these reports are set up, and when they're very solicitous and they insistent upon going through the reports with you. If they're not asking you for your input, if they're not telling you, hey, I want you to look at this report and I want to make sure you understand that report, that doesn't mean they're a good bookkeeper. It means they're a bad bookkeeper. All right. So you want resources. I can share some resources with you because right now we have a waiting list for our bookkeeping service. We do bookkeeping service for hundreds of law firms, and there's a waiting list right now. So I'm not trying to sell that service. And there's a waiting list for our CFO service. I'm not trying to sell that service. But I do have resources that I'd be happy to share with you that you can share with your clients. One of the resources that I'll share is a Zoom webinar series that I did just for our members. It was just members only. They asked for it. So we ran, I think it was like a 3 or 4 hour Zoom presentation on financial literacy, where we went through a whole bunch of financial management concepts and broke them down into very simple terms of like any intelligent teenager could understand these financial concepts. And once you do, it won't be scary. It won't be intimidating. It'll be very empowering. And I can share that with you, that you can share with your clients to watch and learn. That would be a
Perfect.
place to start. And then there's a couple of books that are slipping my mind at the moment, but I'll put that into that resource with references to those books. I didn't write the books, but they're great books. One is the Crabtree book. The other is the Tracy book. Anyway, I rather than guessing, I'll just put it into the thing so you can share with everyone.
Yep. We'll make sure everyone here who's attending live has that. And if you're watching the replay of this, we'll make sure there's a spot on the page where you can go grab that from Arjan.
And I would encourage you to watch the webinar, you know, with your spouse or significant other, because it'll give you a vocabulary to use to communicate about the finances of the business. And if you have, you know, any reasonably intelligent teenagers and you want to give them a head start in life, sincerely, this will do that for them.
Amazing. That's a wonderful resource. Thank you for sharing. We'll make sure that everyone has access to it. One of the elements that I think that it is worth sort of addressing is I've done the thing, I've had the bookkeeper, I've done some of these elements, but I'm also doing a lot of the other things you've talked about over the last while. And the practice is starting to grow. And I'm starting to have more consistency. I'm starting to have the marketing is being better. I'm more confident in the sales, all of the other things we've talked about, you know, over the previous, months and time together. What has to change over a period of time with what you just shared, that any law firm owner or practice sort of running the operation side of things needs to keep in mind? Like, what are the landmines that they are not aware of yet, even if they implemented everything today?
Oh my God. I'm trying to think of how to answer this question. There's so many different ways I can answer this question. Could you be a little bit more specific? Just give me a little bit
so
more.
when you say, like, there's a practice that's doing $250,000 a month, and they're implementing the marketing and they're implementing the sales.
$3 million law firm.
A $250,000 a year. So $250,000 a year.
Oh, a year. Okay.
Yeah. So quarter million a year, law practice,
20,000 a month. Got it.
give or take. And what are the things that they need to keep in mind when they hit that million?
They're getting close to me.
You're good.
The room is filling up.
Nice.
All right. Okay. So I apologize. I got a little distracted. I lost. What were you saying?
If practice owner
firm is a $250,000 firm doing roughly $20,000 a month in gross revenue.
Yep. What are the landmines or the things that they are, don't necessarily see around the corner? Like, there's costs. Like, one of my mentors early on said, all of the difficult challenges come in ones and threes. Your first 100,000, your first 300,000, your first million, your first 3 million, all of these sorts of things. So, I don't necessarily entirely agree with it, but I think that
let's not dive into that. But I can tell you.
But I'm saying,
but I can tell you
there are things that have to change between $250,000 a year to your first million a year.
Yes, I'm going to tell you exactly what it is.
Let's do it.
Like, I didn't understand, but now I understand, and now I this is very simple. Do the math for me, okay? Will you do the math?
Yep.
All right, ready?
Yep.
All right. So a $250,000 a year law firm is grossing $20,000 a month. If it's grossing $20,000 a month, that means the owner of the law firm probably does not have a lot of extra money to hire a staff of people to help them, right? You can't get a gallon out of a pint. You get what I'm saying?
Yep.
Which means the owner of the law firm is doing almost everything themselves. They're doing the marketing, they're doing the sales, they're doing the legal production, they're doing the paralegal work, they're doing the legal secretary work, they're doing the reception work, they're doing everything themselves, right?
Yep.
Okay. How many weeks a year do you think they're probably looking to give the business?
Looking, or the actuality? They're probably looking.
How many weeks a year do you think they want to give the business?
40 to 45.
46 is about the average that we find.
Okay.
right? Because if you add up Christmas, Thanksgiving, New Year's, all the major holidays, that up to 2 weeks, right? So unless you're planning at the beginning of the year, unless you're planning to work on Christmas, work on New Year's, work on Thanksgiving, work on all the major holidays, unless you start the year saying, I'm planning to work on all the major holidays, boom, the first 2 weeks is off the table. Now we're down to only 50 out of 52 weeks. Yeah.
Yep.
And then the next thing is, unless you start the year saying to your family, I'm planning not to take a vacation this year. I'm planning not to see you for a vacation this year. I'm going into this year with the intention of not taking a vacation this year. No, you're probably going to want to take a 2-week vacation with your family. So now we're down to 48 weeks, right?
Yep.
All right. Now, unless you're planning to say to your family, listen, I hope none of you get sick, and I hope none of you have an emergency, and I hope none of you need me for anything, and I hope none of you have any great things that you're planning to celebrate that you want me there for, because I won't be there. No, most people want to be there for weddings, birthdays, bar mitzvahs, funerals, graduations, sick days, parent-teacher conference days, school field trips. The roof leaked and I'm going to stay home and deal with it so my spouse can go do what they need to do. You get what I'm saying?
100%.
Most reasonably emotionally healthy adults, that happens. You don't realize it's happening, but if you actually pay attention, happens about 2 weeks out of the year. So now you got 2 weeks of major holidays, 2 weeks of vacation, and 2 weeks of life's going to happen to you. You got 6 weeks. You're down to 46 weeks a year, realistically, that you got to work with. So you got 46 weeks. You got how I got there?
Yep.
All right. Now, the next question is, how many hours do you think that the average $250,000 a year, basically sole practitioner, wants to give the business all in?
All in, I couldn't tell.
45, 50 hours a week?
Yeah, I was going to guess 50 hours a week.
Let's say 50 hours a week. Okay. Now you got to do the marketing during those 50 hours. You got to do the sales during those 50 hours. You got to do the follow-up on the sales with those 50 hours. You got to do the financial controls during those 50 hours. You have to do some sort of documenting policies and systems and procedures. If you're ever going to grow the firm, you got to invest some time doing that kind of stuff during those 50 hours. Oh, by the way, and you have to do legal production work too. You with me?
Yep.
So out of those 50 hours, let's say that the owner of that firm is like really efficient and they're actually able to bill half, 25 hours a week.
Okay.
Which there's been survey after survey and study after study, which suggests that's optimistic. But let's just call it 25 hours a week. You with me?
Yep.
25 times 46 is how many hours a year are we expecting to actually be able to produce and bill to our clients, assuming, by the way, we don't forget to bill a bunch of stuff.
1150.
46
1150
times 25 is 1150.
Yep.
Okay. And now everyone watching this, you can multiply that times your times your billable rate. Do you have a sense of what your average billable rate is amongst your insureds?
Ranges from 200 to 500 plus. So just say,
let's say 300 an hour.
300. Yep.
Fine. So 1150 times 300 is how much?
345.
345. Now, out of that 345, I'm telling you, we got to take at least 15% and throw it in the garbage because that's work that they're doing that they're not billing for.
Yep.
So let's deduct 15% from that, throw that in the garbage. And what are we at?
293.
Okay. And let's just, for argument's sake, assume that another 5% ends up in accounts receivables. And if you only have 5% in accounts receivables, chances are you have much bigger than a $250,000 law firm, because the bigger the firm is, the smaller the accounts receivable percentage becomes, because you bring in professional financial managers to help you reduce your accounts receivables. But when you're all by your lonesome, accounts receivables tend to be higher. So let's whittle that down and just call it around 250-ish a year. You with me?
Yep.
So does everyone follow how I got there? Do those sound like reasonable, realistic assumptions to make?
Very much so.
Great. So now the question is, how do I get the firm to the next stage of growth? Because the first stage of growth tends to stop around $250, $300-ish thousand. And the reason is because the lawyer runs out of time. There isn't more time. Unless you're willing to sacrifice time with your family, which I don't want you to do, or sacrifice time for your health, which I don't want you to do, there's just not enough time, right? And there's only so much you can raise your rates to make up the difference. And so what you need to do is make better use of the time you've got. And that means hiring people to do things that you don't need to be doing. Hire an assistant, hire someone to manage and control your calendar, hire a secretary to book your appointments, to follow up on things, to run around behind you and clean up the mess so that you don't waste time, because you need to spend more time on productive activities. The highest and best use of a person's time, of a lawyer's time, is marketing. Marketing, because without marketing, there's no sales to make. Sales is second. And without sales, there's no legal work to get done. And without legal work, there's no money coming in. And then you go out of business. You follow me?
100%.
So first is marketing. Second is sales. Third is making sure the legal work gets done. And I want to circle back to the way that I said that very intentionally. Fourth is making sure the firm actually gets paid for the work that's being done. And fifth is doing the work yourself. Now, the way most lawyers, the way most broke, struggling lawyers who never grow their firm past $250,000, and these could be great lawyers, but the reason they never get out of this trap is because they put this in the wrong order. It's like putting on your shoes and then trying to put on your pants and then trying to put on your socks. It's the same things. You just have to do them in the right order for it to work better, right? The way most broke, struggling lawyers do this is first they say, I'm going to focus on doing the work. Well, if you're doing all the work yourself, there's no time left to do everything else. And then they say, okay, I've run out of work to do. I now need to do marketing. And they turn the marketing on and they turn the marketing off and they turn the marketing on and they turn the marketing off, and they create this feast or famine. And then they only bother to follow up with prospective new clients who didn't hire them, i.e. sales, when they're broke and desperate, which is the worst time to be talking to a prospective new client. And then they only get around to doing the billing later on as an afterthought. So they just do it in the wrong order. If you want to get your firm, if you've been hitting that $250,000 barrier and you can't figure out how to get past it, right? And by past it, I mean $500,000, not $251,000. It's paradoxical. It's a function of doing less, not doing more. You don't have to work smarter. You have to work less. Do less of the secretary work. Do less of the paralegal work. Do less of the junior associate work. Does that make sense?
100%.
You don't save your way from 250,000 in revenue to $500,000 to $1 million in revenue. You spend your way, but you got to spend it on freeing yourself to buy your freedom so you can focus on doing the things that are the higher and better use of your time.
And along the way, you're using the financial controls to keep a pulse on everything. So if you are overspending, you can warrant it or justify it, just closing the loop. So that you have a much better pulse on where you're at and a much better pulse on the things that are the revenue generating activities that will allow you to grow the business using more who's and figuring everything else out on your own a lot less.
You know, Dre, on that stage, well, it's not there yet, but there will be a stage there. Saturday night, we're going to have a celebration. Every January, we have a celebration of law firm owners whose law firm broke the 7-figure barrier for the first time in the previous year. This year, out of our 600 and something members, I think 25 or 30 of them, their firms broke the 7-figure barrier for the first time last year. That's not
Amazing.
to say that, I mean, and every year, we've got 15, 20, 25, but this year we're gonna have like 30 whose law firm broke for the first time last year. And as part of the ceremony, we give them a little award. As part of the ceremony, they talk about things they did that made it harder on themselves than it had to be. And every year we do this, and we've been doing this for, I don't know, maybe 10 years. Every year we do this, every January, one of the themes over and over and over again, I made this harder on myself than it had to be because they wouldn't hire people soon enough to buy their freedom, and they get stuck.
I can relate. I think we've all been there in some form or fashion. It's one of those things that sometimes you got to get out of your own way.
This is true.
Any parting thoughts you want to make sure that we just leave everyone with as we wrap up today?
Yeah, I'm terrible at math. I don't have an MBA. I don't have a finance degree. I didn't study business in college. My undergraduate is communications law, economics, and government. Don't for one second think that economics has anything to do with math or business or stuff like that. It doesn't. I learned this. I don't presume to be any smarter than you. There's a very good chance that you are smarter than me. I definitely don't work harder than you probably work. I learned this stuff. You can learn it too. If you are willing, I would love for my company to share resources with you, and we'll share these for free to help you learn this stuff. If for whatever reason you don't want to learn it from me, you don't want to learn it from how to manage a small law firm because you don't like our style or whatever, that's okay. I mean, it's disappointing to me, but don't use that as an excuse. Don't make any excuses. You can learn this stuff. It's enormously liberating. I used to hate the financial management of my business. I literally have learned to love it. I love the monthly meetings when I sit down with my team and I go through the budget and I go through the budget variance report and I go through the cash flow projections. I literally love that time of the month. And you got to understand how much I used to avoid it and I hated it, but I learned how to do this, and you can too.
Well, it's a good way, to wrap it up today. Arjan, appreciate it, man. We'll actually, for everyone listening and watching, we've got a variety of topics that we'll be filming together in person that we'll be covering through the rest of the good portion of the year. So starting with next month, we'll have us sitting side by side doing these, coming at you each month. So excited about that. Arjan, good luck with the event, and we'll see you in next month's edition.
Thanks. Look forward to seeing you. Thanks, everyone.
Thanks, everybody.
Bye.